What is transaction monitoring? Transaction monitoring is the process of reviewing customer transactions and comparing them against their risk profile and unusual transaction patterns. It involves closely examining transactions and identifying any suspicious activities. Transactions can include transfers, deposits, and withdrawals. What is the need of transaction monitoring? The main objective of transaction monitoring is to protect banks from money laundering and terrorist financing activities. By monitoring transactions, banks can detect and prevent illicit activities, avoiding regulatory fines and penalties. What are the rules or protocols that should be included in a transaction monitoring program? When establishing a transaction monitoring program, the rules and protocols are set of rules depending on different risk factors. There are some basic rules in transaction monitoring systems such as Rule 1. Identifying transactions that are broken down into smaller amounts to evade reporting obligations. Such transactions can be detected by setting a threshold slightly below the reporting limit and searching for patterns within a specific time frame so that activities can be detected. Rule 2. Modifying personal identifiable information just before a big transaction or payment, which may indicate account takeover or attempts to hide money's transaction route. Rule 3. Transactions that deviate from the customer's typical spending behavior based on income level and occupation indicates unusual spending patterns. Rule 4. When payments for a particular merchant are received from a limited number of consumers, particularly on platforms where multiple buyers engage with a single seller only. Rule 5. When the total amount of credits is similar to the total value of debits over a particular period and it raises suspicion when such a balance is inconsistent with the nature of the account and nature of business. Rule 6. Transactions involving nations and high-risk countries vulnerable to money laundering include those with high banking secrecy, significant financial crime exposure, or recognized tax havens. Rule 7. Accounts that immediately withdraw funds upon deposit and such rapid movement of funds can be indicative of money laundering, especially when large amounts are deposited and withdrawn frequently. Rule 8. Suspicion is raised when a large number of cash deposits are inconsistent with the customer's profile or expected behavior. What is the process flow that is generally followed in transaction monitoring systems? The transaction monitoring process generally involves the following steps. Step 1. Triggering a notification for a potentially suspicious transaction. Step 2. Gathering relevant customer profile details. Step 3. Examining past transaction alerts associated with the customer. Step 4. Analyzing regular transaction patterns for comparison. Step 5. Conducting a thorough investigation of the flagged transactions. Step 6. Evaluating the activities for any indications of suspicious behavior. Step 7. Seeking guidance from a compliance officer when required. Step 8. Formulating a final determination regarding the suspicious nature of the transaction. We can say that transaction monitoring plays a crucial role in safeguarding banks from illicit activities. By utilizing technology and implementing effective rules, financial institutions can detect and prevent money laundering and terrorist financing. Understanding red flags and following a thorough transaction monitoring process are key to maintaining regulatory compliance and protecting against financial risks. Next video will be on SAR and what are the important points need to be kept in mind before filling SAR. Thanks for watching this video. I made this video with the help of ChatGPT. Please subscribe, like and comment for AML transformations.